30,000 jobs gone. $10 billion in office value evaporated. A downtown vacancy rate that would make Detroit blush, 32% and still climbing. And the mayor's response, when a landmark report landed on her desk documenting all of it in precise, documented detail, was to call the tax that caused it a key reason why Seattle was able to bounce back. That sentence tells you everything you need to know about what is happening to one of America's most consequential cities right now. And it tells you exactly where it goes from here. Hey everyone, welcome back. It is 2020, a city that has spent the last decade riding the greatest tech boom in American history. Amazon, Microsoft, Expedia, CEO, all headquartered or concentrated within its limits, decides the moment has arrived to make its largest employers pay more. The logic sounds airtight. A pandemic is burning through budgets. Housing costs have spiraled out of reach for working people, and the companies whose employees have transformed the city into one of the most expensive places to live in the country should contribute proportionally to fixing what their success has strained. On July 6, 2020, Seattle City Council passes the Jumpstart Seattle payroll expense tax by a 7-2 vote. Councilmember Teresa Mosqueda, who architected the legislation, calls it a huge win. The tax targets the city's largest employers, those with payrolls exceeding $7 million who pay at least one employee over $150,000 per year. The rates are tiered. The biggest payers are the biggest companies, Amazon, Microsoft, the companies that made Seattle. The tax is expected to raise over $200 million annually. The council is unified. The advocates are celebrating. And then Amazon opens an email. The subject line is an announcement from the Senior Vice President of Worldwide Operations. The entire worldwide operations team, thousands of people, will begin relocating from Seattle to a neighboring city just 10 miles east. The city's name is Bellevue, and it has no Jumpstart tax. I'm talking about Seattle's Jumpstart payroll expense tax passed by City Council on July 6, 2020, championed as a progressive breakthrough, and now, 5 years into its existence. The subject of a landmark Downtown Seattle Association report released on June 15, 2026, documenting its consequences in precise and devastating detail. The report is called The Tale of Two Cities. The two cities are Seattle and Bellevue, separated by Lake Washington and 10 miles of highway. And what those two cities look like 5 years after Jumpstart, one with 30,000 jobs lost, an office vacancy at 32%, the other with job growth up 12.6% and commercial values rising, is the story that Seattle's new mayor, Katie Wilson, is now responsible for answering. Wilson took office on January 1, 2026. She is 43 years old, a self-described Democratic Socialist, co-founder of the Transit Riders Union, and one of the architects of the political environment that produced Jumpstart, and she inherited a city that the data says is losing badly. The Jumpstart tax was not designed as a permanent revenue mechanism. It was sold as COVID relief emergency funding for a city in crisis, to be wound down as conditions normalized. But in 2023, Mayor Bruce Harrell diverted Jumpstart funds away from their designated housing and affordable housing purposes and into the general fund to cover basic city operations, because the rest of the city's revenue base was falling apart. The commercial property tax base had already begun to collapse. The office vacancy rate was rising toward 30%. The high-paying jobs that generate the income taxes and business taxes that fund city services were departing to Bellevue, to remote work arrangements. Two cities that hadn't imposed a tiered payroll tax on top of an existing business and occupation tax that is already 2 to 4 times higher than Bellevue. And in February 2025, with the DSA report already taking shape, Seattle voters approved Proposition 1A, adding a 5% tax on compensation above $1 million. Layered on top of Jumpstart, layered on top of B&O taxes, layered on top of a property tax rate that had risen 48% since 2019 while Bellevue's declined 16%. The city was not responding to the problem, it was compounding it, and now it faces a $140 million budget shortfall for 2027, and a projected deficit approaching $500 million by 2029. What was sold as a jumpstart is revealing itself as a slow drain, and the new mayor is publicly searching for more progressive revenue to fill the gap. So, whether you live in Seattle, work in tech, or just pay taxes anywhere in this country, what's unfolding right now in the Pacific Northwest matters to you. Because this pattern has a very predictable ending, and we've seen it play out before. This is Inc. Tribune, and this is where we follow the money. Subscribe and hit that like button if you want more of this. And here's my question for the comments. When a tax sold as pandemic relief becomes a permanent feature of city finance, and the businesses it targets move 10 miles away, who exactly is paying for the services the tax was supposed to fund? Drop it below. Let's get into it. First, let's understand who Katie Wilson actually is. Because the name is new to national audiences, and it absolutely should not be. Catherine Barrett Wilson was born on July 12, 1982, in Binghamton, New York. Her parents are both evolutionary biologists. She attended Balliol College at Oxford University and dropped out. She moved to Seattle and spent more than a decade as a community organizer and activist. Co-founding the Transit Riders Union, an advocacy group focused on public transit equity and workers' rights. She held no elected office before November 2025. Her political career began, for practical purposes, when she decided to run for mayor because incumbent Bruce Harrell refused to support a business tax to fund a public housing scheme. She entered the 2025 race in March 2025. She placed first in the August primary. She defeated Harrell on November 13, 2025. By just over 2,000 votes out of nearly 280,000 cast, a margin of 0.7 percentage points, the closest Seattle mayoral race since 1906. She took office on January 1, 2026. 6 months later, the Downtown Seattle Association published The Tale of Two Cities, and Mayor Wilson's response, in a public statement, was this: because of Seattle's ongoing economic strength. This tax on the highest salaries paid by the largest corporations has raised far more money over the past several years than originally projected. Read that again. Her evidence that the economy is strong is the amount the tax is collecting. The report she was responding to said, the reason the Jumpstart projections had to be revised downward by $76 million in 2026 was that the high-paying jobs generating the tax had left the city. That is not economic strength. That is a shrinking base generating declining returns from a narrowing pool of remaining employers. The mayor called it a success. Here is what the Downtown Seattle Association report actually says. Released on June 15, 2026, The Tale of Two Cities is not an advocacy document. It is a data comparison. These are its core findings. Since the Jumpstart tax took effect in 2021, downtown Seattle has lost approximately 30,000 jobs. Between 2023 and 2025 alone, Seattle shed 1.3% of its total employment. Office vacancy in the downtown core rose from 6.7% in 2019 to 32% in 2025. Downtown office properties fell 48% in assessed value between 2020 and 2025. More than $10 billion in office value has been lost. Seattle's property tax rate rose 48% between 2019 and 2026. Bellevue, 10 miles away, with no Jumpstart tax, no excess compensation tax, and a business and occupation tax 2 to 4 times lower than Seattle's depending on industry. Added jobs, Bellevue's labor pool grew 12.6% between 2023 and 2025. Downtown Bellevue office properties increased 7% in assessed value over the same period. Bellevue's property tax rate declined 16%. TikTok leased 450,000 square feet in Bellevue for its Pacific Northwest expansion. The Peckham & Company International signed one of the largest office leases in the region in Bellevue. Amazon, Jumpstart's primary target, had 14,000 employees in Bellevue by late 2024 and is building a campus designed to hold 25,000. The official framing from Mayor Wilson was that Jumpstart had been a key reason Seattle was able to bounce back from the worst economic impacts of COVID. King County Councilmember Teresa Mosqueda, who architected Jumpstart, called the DSA report revisionist history and said it ignored the fallout of the pandemic. She said, and this is a direct quote, "I think it's a lazy talking point to try to point fingers when truly this was the source that kept Seattle's budget in the black for the first 4 years of the pandemic. But here's the thing about that framing. If Jumpstart kept Seattle's budget in the black, Seattle would not currently be facing a $140 million shortfall in 2027 and a $500 million projected deficit by 2029. The tax that saved the budget is now insufficient to fill the hole left by the departing businesses and collapsing commercial property values that the tax helped create. And the city's response is to look for more taxes. This is not a Seattle original. The playbook has been run before, at greater scale, with similarly documented results. San Francisco passed a gross receipts tax in 2012 and expanded it multiple times through 2020. Its downtown office vacancy rate reached 37% in 2024, the highest in the country. Salesforce Tower, the city's most iconic commercial property, saw its owner default on its mortgage. Major employers, including Palantir and Charles Schwab, relocated. Chicago's Loop District spent a decade watching corporate headquarters depart for Texas, Florida, and other states following sustained tax increases, hitting 62% office vacancy in some submarkets by 2024. In both cases, the city's political leadership initially defended the taxes, then quietly noted the unexpected budget shortfalls, then proposed new revenue measures to compensate. Amazon left downtown Seattle for Bellevue. TikTok chose Bellevue for its Pacific Northwest home. The Peckham & Company chose Bellevue. Thousands of employees are crossing Lake Washington every morning in a direction that moves their paychecks, their spending, and their tax contributions 10 miles east. All gone. All landing in a city with a fraction of Seattle's tax burden. The city that made Amazon is waving it goodbye. and then proposing new levies to fill the gap. On June 15, 2026, the same day the DSA released its report, Mayor Katie Wilson issued a public statement. In full, her defense of Jumpstart included this: Seattle's Jumpstart payroll expense tax is a key reason why the city was able to successfully bounce back from the worst economic impacts of COVID because of Seattle's ongoing economic strength. This tax on the highest salaries paid by the largest corporations has raised far more money over the past several years than originally projected. Read that again. The report that prompted her statement documented 30,000 jobs lost, $10 billion in office value erased, and a 32% vacancy rate. The mayor's evidence of ongoing economic strength is that the tax exceeded its original revenue projections, a projection that was itself revised downward by $76 million in 2026, because high-paying jobs had left the city. Teresa Mosqueda, now on the King County Council, called the findings revisionist history. John Scholes, president and CEO of the Downtown Seattle Association, said, simply, "My top takeaway is Seattle's lost its economic mojo." The Washington Policy Center noted that in February 2025, with the evidence of Jumpstart's impact already visible, Seattle voters approved Proposition 1A, adding a 5% tax on compensation above $1 million, layered directly on top of Jumpstart's existing structure. The city is not rethinking the model, it is extending it, and Mayor Wilson has publicly said she is searching for new sources of progressive revenue to fill a budget hole that now runs to nearly $500 billion by 2029. That is a quiet verdict on where this leads.